A man in Illinois lost his entire home over a $1,600 tax bill. He didn't sell it, he didn't borrow against it. A stranger bought his debt, took the house, and legally kept $150,000 of his equity. This isn't a housing crash. In some ways, it's worse, because people are losing homes they thought were already safe. Here are the 10 states where holding on to a home is getting hardest. Number 10, New Jersey. When you have a mortgage, the bank usually makes you pay your property taxes and your home insurance bundled right in with your loan payment, all in one chunk. That bundle is called escrow. And here's the part nobody warns you about. Your loan payment can be frozen for 30 years, but that escrow bundle can climb every single year. When your taxes go up, the bundle goes up. You didn't borrow another dime, and your bill went up anyway. Keep that idea in your head, because it's the engine behind almost everything on this list. Nowhere is it worse than New Jersey. The effective property tax rate there is one of the 5 highest in the country, about 1.5%. On a lot of homes, the property tax bill alone rivals the actual mortgage payment. $12,000 a year in taxes is normal in plenty of towns. And those taxes do not freeze when you retire. Your pension is fixed. Your tax bill is not. So you get a couple who lived in the same New Jersey house for 40 years, raised their kids there, paid the place off, and now they're being forced to sell and leave the state because they cannot cover $12,000 a year in taxes on a fixed income. The state is now sitting on more than 300,000 vacant and abandoned homes. That's what it looks like when the cost of staying finally beats people. I'll say this plainly. Your mortgage retires. Your property taxes never do. Number 9, Maryland. This one's quicker, and it's a little different from the rest. Maryland just posted the 3rd worst jump in serious mortgage delinquencies in the whole country, which is just a fancy way of saying a lot more people suddenly stopped being able to pay. And it lines up almost exactly with the job market. Unemployment there climbed to 4.4% in April, up more than half a point in a year. But I want to be honest with you about who's getting hit here, because it's not mainly retirees. In Maryland, it's working-age families in those middle-class suburbs outside Washington. Somebody loses a job. The savings cushion is already gone, eaten up by a few years of high prices. The pandemic protections have expired, and the foreclosure notice shows up before they've found new work. No big villain in this one, just a steady job market softening and families with no buffer left. Sometimes that's the whole story. Number 8, Louisiana. Let me ask you something. What happens to a house when nobody will insure it? Because in Louisiana, that's not a what if. The insurance market there is the worst in the nation. For every dollar insurers collect in premiums, they're paying out about $1.43 in claims. That math doesn't work, so they either raise the price until people can't pay, or they leave. And nearly 1 in 5 homes in the state now has no insurance at all. For families with a mortgage, that's a trap with no exit. The bank requires insurance, so when premiums explode, the escrow bundle explodes with it, and the payments slide into delinquency. Louisiana just had the 2nd biggest delinquency jump in the country. But for the folks who dropped coverage to keep the lights on, it's worse. They're living one storm away from losing everything, and they know it. I've read about families down there where the insurance costs more than the actual mortgage, so they cancel it just to buy groceries, and then they pray through hurricane season. That's not carelessness. That's people doing the math and running out of good options. Number 7, Texas. Texas leads the entire country in raw foreclosure starts, more than 3,500 in a single month. Now, part of that is just size. It's a huge state with a huge number of homes. I'll be fair about that. But the pressure underneath it is real. Texas brags that it has no state income tax. What it doesn't put on the billboard is how it makes up the difference, with some of the heaviest property taxes in the country, around 1.8%, dropped straight onto homeowners. Stack a $6,000 tax bill on top of a $4,000 insurance bill, and you're paying $10,000 a year just to exist in a house you supposedly own. And here's the cruel twist. For years, builders flooded Texas with brand new homes. So now, when somebody falls behind on those taxes and tries to sell their way out of trouble, they can't find a buyer, because there are empty new builds all around them dragging prices down. Can't pay, can't sell. The house just slides into foreclosure while they watch. But Texas is at least a tax bill you can see coming in the mail. The next state is quieter, and the people getting hit there never saw it coming at all. Number 6, Indiana. Indiana sits near the very top of the foreclosure rankings, about one filing for every 1,600 homes. And it's a state where the overall job market actually looks fine on paper. Unemployment's low. So what's cracking? It's the first-time buyers, specifically the ones who used FHA loans. Those are government-backed loans that let you buy with a very small down payment, which is how a lot of younger working-class families get their first house. Across the country, the delinquency rate on those FHA loans just hit 11.5%, the highest in years. In Indiana, that's the bleeding edge. I'll be honest with you, the way I'd want somebody to be honest with me. This one isn't really about seniors who own their homes outright. This is the entry-level dream failing. Young couples who stretched to buy their first place then got crushed by everyday prices climbing faster than their paychecks, with the safety nets now gone. Different generation, same squeeze. Real quick before number 5, if this kind of plain English breakdown is useful, hit subscribe. That's the whole ask. Now, let's keep going. Number 5, Delaware. Delaware spent years selling itself as a retirement haven. Low property taxes, friendly to folks living on a pension. And for the homeowner who's already settled and paid up, a lot of that's still true. But the working residents are living in a different Delaware. The state now has one of the highest unemployment rates in the country, 5.3%, and back in April, it actually hit the worst foreclosure rate in the entire nation, one filing for every 1,700 homes. Jobs dried up over the last year, savings ran out fast, and the foreclosure filings piled up. Now, one honest note, because I don't want to scare anybody who lives there. Delaware runs a mandatory program that sits a struggling homeowner down with the lender before anything final happens, and it has a strong record of stopping foreclosures that have already been filed. So a filing in Delaware doesn't always end with somebody losing the house. That matters. I'd rather you have the full picture than just the scary half. Delaware at least admits it's got a problem. The next state does the opposite. It looks like it's booming, and that's exactly what's hiding the damage. Number 4, South Carolina. South Carolina has the second worst foreclosure rate in the country, and almost nobody talks about it because on the surface, the state looks like it's thriving. People are moving in, money's flowing toward the coast and the cities. So how do you square a boom with all these foreclosures? You square it by looking at who's moving in versus who already lived there. Wealthy folks are relocating from higher-cost states and paying top dollar. That drives up home values across the whole neighborhood, which sounds great, until you realize your property taxes get reassessed based on those new, higher values. So a local who's worked the same steady job for 10 years, whose wages haven't budged, suddenly gets a tax bill and an insurance bill that doubled because of what the newcomers are paying. The wages stayed flat. The cost of staying put didn't. In the Columbia area, it got bad enough that 1 in every 165 homes faced a foreclosure filing in a single year. Picture a moving truck with out-of-state plates pulling into a driveway, rolling right past a bank auction sign on the lawn 3 doors down. That's the whole story in one image. Number 3, Illinois. I want to come back to that man from the very start of this video, the one who lost his whole house over a small tax bill. Because Illinois is where that happens, and I need you to understand exactly how, because it's worse than it sounds. In most places, if you fall behind on property taxes, you owe the back taxes plus a penalty. Fair enough. But Illinois has long run a system where a private investor can buy your tax debt from the county, sometimes a debt as small as $1,600. If you can't navigate the complicated process to pay it back in time, that investor doesn't just collect what you owed. Under the old rules, they could take the entire house and keep every penny of the equity inside it. A man falls behind on $1,600 during a medical emergency, and a stranger from out of state ends up with $150,000 of his life savings. The original owner gets nothing, not a dollar back. In Cook County alone, researchers documented more than $100 million in home equity stripped from people this way. And it landed hardest, every time, on the folks with the least room to absorb a surprise bill. Seniors, low-income families, people one emergency away from the edge. Here's what I think about when I read these files. This was never an accident or a loophole nobody noticed. It was a working system, running for decades, quietly moving wealth from the people who lost their homes to the people who bought their debt. The only reason it's finally changing is that the Supreme Court ruled in 2023 that keeping a person's surplus equity is unconstitutional, and Illinois just passed a law to force that excess value back to the homeowner. Good, it's about time. But think about how many people lost everything before anyone in charge decided it was wrong. That one still makes me angry, if I'm being honest with you. The next 2 states aren't about anybody scheming. They're about a number that just kept climbing until regular people couldn't keep up. And the worst case I found is next. Number 2, Colorado. Picture opening your mortgage statement and finding the payment jumped $400 in a single month. Same house, same loan, same people. $400 more overnight. That's been landing in mailboxes all over Colorado. Home insurance premiums there have done something I've genuinely never seen before. Between 2020 and 2025, they didn't just rise, they doubled. A 100% increase, the largest in the entire country, driven by years of catastrophic wildfire losses. In 2025 alone, the average premium jumped more than 18%. And because a typical home around Denver already costs around $600,000, families were stretched to the absolute limit before the insurance even moved. There was no cushion left to absorb a doubling. You can see the panic in the phone lines. Calls to the state's foreclosure prevention hotline shot up 51%. And here's the part that tells you who's really getting hurt. By the time people call that hotline, 8 out of 10 of them are already behind on their mortgage. They're not calling to plan ahead. They're calling because it's already happening. More than a third of those callers are 60 or older, retirees who can't just go ask the boss for a raise to cover an extra $400 a month. When insurance doubles in 5 years and incomes don't move at all, this is the math. And the math doesn't care how long you've lived there. And if Colorado shows you how fast this can hit, the last state shows you how cruel it gets. Because the people losing the most there don't owe a dime on their homes. Number 1, Florida. Of course it's Florida. the single worst foreclosure rate in America, one filing for every 2,110 homes. And on top of that, an unemployment rate that jumped a full point in a year, the second fastest rise in the country. But the numbers aren't really the story here. A widow I'll never forget reading about is the story. She paid off her condo near the water 11 years ago, owns it outright, owes nothing to anyone. And this year, she's being forced to sell it because her insurance and her HOA fees tripled and swallowed her entire monthly income. Florida spent generations as the place you retired to. You worked your whole life, paid off a little place near the water, and lived out your years on a fixed pension and Social Security. For decades, that worked. Now, the storms have made insurers desperate. They've doubled premiums or pulled out of the state entirely. HOA boards are hitting owners with special assessments worth thousands of dollars to repair aging buildings. And none of that touches the mortgage. The mortgage might be long gone. That's what makes Florida the clearest example of everything we've talked about. You can do everything right. Buy modestly, pay it off, owe nothing to a soul, and still get pushed out of your own home in your 70s by costs that have nothing to do with the loan and everything to do with just keeping the lights on and the roof insured. A retiree on a fixed check simply cannot conjure another $1,000 a month out of thin air. So the home goes. I'll give you the fair counterpoint because credibility matters to me. Florida passed some reforms that have started to slow those premium increases, and a chunk of the foreclosure activity is older cases finally clearing the system. It is not the apocalypse. But when the notice is taped to your own door, the average is improving is awfully cold comfort. So that's 10. And now I want to tell you what this actually is, because the headline version is going to be wrong, and I don't want you walking away believing it. The headline will say, "The housing market is crashing." It isn't. Most homeowners in this country are fine, locked into low payments, sitting on equity. What's actually happening is narrower, and in a way, more unfair than a crash. A crash hits the people who gambled. This is hitting the people who did everything they were told to do. That man in Illinois didn't overborrow. That widow in Florida didn't either. She paid her house off. The people getting squeezed out are the ones who can't simply earn more money. Retirees, fixed income families, first-time buyers with no cushion. For them, the cost of keeping a home, the taxes, the insurance, the assessments, is rising faster than any check they've got coming in. And that's what I keep coming back to. We spend a lot of time worrying about whether young people can buy a home. We should also be asking whether the people who already own one, who paid for it honestly, can afford to hold on to it. Right now, in these 10 states, a lot of them can't. Now, I'm not going to pretend there's an easy fix for any of this, but there are two things worth knowing because almost nobody tells you. The first one, if your property tax bill jumped this year, you can fight it. Every county has a process to formally appeal your assessment, and a lot of people win because the county got the value wrong. It costs you nothing but a little paperwork and a deadline you can't miss. The second one, most states have a homestead exemption or a senior tax freeze program that can lower or lock your property taxes once you hit a certain age. And a shocking number of people who qualify never sign up because no one ever told them it existed. Call your county assessor and ask. Worst case, the answer is no. Best case, it's the thing that lets you keep your home. So now I want to hear from you. Has your property tax, insurance, HOA fee, or escrow payment jumped this year? And if your home is paid off, does it still feel affordable to keep? Tell me your state in the comments, because those real stories show what the numbers miss. I read every single one, and these are the stories that actually tell me what's happening out there better than any report. And if this helped you understand what's really happening, subscribe. This is EconoNova. Keep an eye on the price of milk.